everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today, making a return appearance, is Phil Silverman, CEO of P. Silverman and Company. Phil, nice to have you back.
Good to be here.
So listen, I'm very curious. I know you guys, in what you do, a lot of it is based on volatility. We just went through a pretty volatile period recently. I mean, at the utterance by Bernanke about maybe bringing on the taper, okay, and stocks sold off, I think, about 7%. We had just about all of that recovered. How does it look going into the summer? Well, we're in the summer, but I mean, normally this is could be a quiet period. Sometimes it could get crazy.
Historically, it's been a quiet period. The last couple of years, summer's had a lot of action with the government budget thing and then the EU. But, you know, we saw that big move down in the markets. Volatility spiked significantly, but now it's been steadily coming down the last about week and a half. Volume is low in the markets. The equity markets are moving straight up, and like I said, volatility is coming back down. I'm a bit surprised how quickly it's come down. Everyone's kind of moved away from the whole taper thing. I think a lot of that stems from the fact that the stock market is viewed as the best possible alternative. Not necessarily a great place to invest, but what's better? Where else do you go right now? The rest of the world is struggling much worse than we are. You know, we saw part of the rally, part of the sell-off, rather, that came around the Bernanke time was also a bit focused on China. We were seeing a lot of worries about a financial crisis in China, and you know, they were trying to clamp down on the shadow banking system, and now they, you know, kind of loosened up a little bit their rhetoric, because I think they want to have a controlled tightening.
So all those Western-educated MBAs going over there and mucking everything up. Same sort of disease that we have here.
Yes.
But how about commodities? I mean, commodities have really quieted down. If we think back, you know, last year, especially a couple of years ago, I mean, things were on fire. Now, maybe with the exception of oil, but it's also kind of quiet. It's creeping up. But gold, big sell-off. Grains, other commodities have really come down. What do you see there?
Well, the whole inflation trade has flipped, and now people are worried about deflation. And that's where we've seen, especially in the gold and the silver markets, everyone's kind of run the other way. And it's happened very quickly because the late entrance into the gold market, remember, we're up for 13 years in gold. The people that came in at the end are the people that don't...
Like John Paulson.
Like John Paulson and fund managers that can't sit on a losing position, especially when the equity markets are rallying so hard. So they need to get out of it. They need to get out of it quick. And the general idea that the worry about deflation rather than inflation has moved everyone outside of those commodities. Now, oil's obviously its own beast. You know, the Middle East, this whole Egypt situation is not going to go away easily, and so we've kind of been staying a little bit out of oil because it's really tough to call that. But I don't see any reason why Egypt is going to be resolved.
It looks like it can become another Somalia. I mean, without a government, basically. You have the military and then...
Yeah, the Muslim Brotherhood is not going to walk away easily. It's going to be a fight over there. So oil is doing its own thing. You know, as we talked before, you know, gold's a tough place to be right now. You know, I don't think that we're going to see any significant rebound in gold. But by the same respect, it's come down so much, I would be very careful trying to short it because markets don't move in one direction. And the snapbacks could be very, very fierce. And then if you believe gold's a good investment, if you still are worried about inflation in the future, and there's a chance of that.
And you want to be buying on these
you want to be,
pullbacks. You have to be patient, though,
I think patience is the way you want to play gold right now. I would say, you know, there's no need to be a hero. There's other places that you could move around. And then the other real interesting thing are these the credit markets, the treasury bonds. I mean, this move in them has really spooked out a lot of people. And we've been talking to clients who they're seeing their statements, and they've never seen their bond allocation lose money. And they're just in shock. So I think that's going to have deep reverberations for the entire asset allocation across the space of the market.
I don't see interest rates going much higher than where they are right now. I think it was partially a reaction to the idea that we may be close to the taper, right? And also partially the fact that the economy keeps sort of, muddling through, chugging along at around a 2% growth pace, and it's not going into recession. But we probably I think we hit the upper end of rates on the 10-year where we've seen it. And we'll probably see it pull back down again.
I would agree. I was surprised they got as high as they did. I thought they would kind of settle in a more near 2.5. But I think there were so many people that were kind of thinking the same thing. It overshot.
Yeah.
But it'll be interesting to see the path that they take, because they definitely have a major effect on the global view of things.
What strikes me, or what was interesting, was how long it kind of took for people to realize that all the monetary operations of central banks didn't really equate or flow through to any kind of inflation, and we had a lot of people, claiming we were going to get even hyperinflation, right?
Yeah.
Like a Zimbabwe or Weimar, and that it took a while for that perception to kind of turn around, but that's in fact what's happening right now, right?
Yeah, I think people didn't realize the mechanism of the transmission of the stimulus. It went to the banks. They were able to get low funds, but it was not getting into the real economy.
It just sat there in the banking system.
Velocity of money was not picking up. People were still underemployed. It wasn't an inflationary situation. Now, could we see inflation at some point in the latter part of the decade? Possibly. I mean, we'll see what happens then. But right now, there does not seem to be any fear of inflation. Maybe on Main Street, seeing their gas prices go up.
Yeah, but they went up and they plateaued, and it's a relative price story. Other things have come down. I don't see it because I still see austerity as the main policy thing that's happening right now. I mean, we have the sequester here in the United States. We still have austerity being applied in Europe, despite the fact that it's been a disaster. Even Japan, when Abe got elected, everyone thought, he's going to change the game and it's going to be stimulus, and then it was like kind of right back to the same old model. And so with the austerity in place, I just don't see where the real inflation is going to come from. That's not to say we won't have cycles, right? We can have, and it will, within those cycles, will create a good buying opportunity for a lot of these markets.
Oh, yeah.
Right?
Absolutely. I think there's a potential that we see the sell-off in commodities give you an excellent opportunity to add to that allocation. But like we said before, patience. Patience is one of the most important things when you're looking at long-term investing, because these things do cycle, and you get an opportunity to get in at good prices.
Right.
Just everyone sees, everyone saw gold come down a little bit, and they jumped in. Oh, it's going to go back up. Then it went down again, and there was a whole new group of people that came in and said, "Oh, now it's a deal." Be patient.
Patience is rewarded.
Absolutely.
The famous saying.
Yes.
Phil Silverman, thank you very much.
Thank you.
Thanks. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.